Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 74. And this week on the podcast, we're talking about animal spirits and consumer confidence. Animal spirits is an economic term. It's been around for maybe 100 years or so that's used to describe risk-taking activities that we as consumers engage in across the economy. And right now, my observation is that animal spirits are really, really high. And so this week on the podcast, we talk about how we measure those animal spirits and consumer confidence and what that might mean for the markets and our lives and our portfolios. I hope you enjoy it. Okay, so this week on the podcast, I want to talk about animal spirits a little bit. And when you go through school as a financial person, you don't necessarily have to have a background in finance to get into it. There's a lot of people that come from all kinds of disciplines, whereas, the more technical fields, if you're an engineer, you have to go through engineering school. If you're a lawyer, you have to go to law school and pass the bar. In finance, the bar for being a credentialed professional is, unfortunately, and I think and hope that this changes, but unfortunately, it's really quite low. And so a lot of people, I think, in the industry they come from various backgrounds, and knowledge of economic history and theory is not really a requirement for being a financial professional. That said, I have a lot of background just because I've always been interested in it. So my undergraduate degree is in applied economics. I have an MBA, and I'm just really interested in this stuff. And as part of trying to do the best I can in my day job, I study up on economics and economic history quite a bit. And the only reason I'm boring you all with this kind of background is that we're in kind of a unique situation with regard to what's going on in the markets, in the economy, and in the world right now. And you're hearing me say this, and you say, yeah, no, Doug, Grant, we're in the middle of a pandemic. We haven't had one in 100 years. I've been locked in my living room for the last 12 months. Of course it's unique. Well, that's very true, but not quite what I'm talking about. What I wanted to spend time discussing on the podcast this week is this concept of consumer confidence and how it impacts the economy at large, and as a byproduct of that, the financial markets. And there's this term that John Maynard Keynes came up with about 100 years ago. He was an economist, really a leading economist that wrote a ton of books and Nobel Prize and all this stuff back in like the 1930s, 1940s. And he coined this term called animal spirits. And animal spirits has to do with the risk-taking proclivities of consumers in different parts of the economic cycle. And when things are going pretty well in the economy and people have confidence in general, they're more willing to go out there and take entrepreneurial risks. They're more willing to do other things in their personal lives. They're more willing to travel, spend money, as opposed to when the economy is not doing so well. People generally don't want to go out and blow 100% of their paycheck every week. They want to put something away in savings because they're not quite as comfortable about the economic situation. And it's a totally logical behavior for humans to exhibit. If you're not so hot on the chances that you're going to get a raise next year, maybe not so hot on the chances that you're going to retain your job for the next 12 months, well, you better put a little bit more money away. And so as we go through these economic cycles, as a practitioner in the financial markets, as someone who manages a lot of money for people, I'm always looking at the performance of the markets, what's going on in individual companies and asset classes and the markets in general and kind of macro stuff. But then I'm also looking at other factors like just random observations that I can't characterize any other way than animal spirits. So there are ways that we can or that economists, I should say, do try to quantify this. And so one of those ways is through a consumer confidence index. And there's a group, I can't remember the name of the group, but they come out with this index where they survey just a bunch of random people around the country every single month and grade their scores relative to a baseline benchmark. And they've been doing this since 1985. The first time they gave the survey, they got everybody's responses, and that was the baseline. So that first survey in 1985, they gave a score of 100. And in years and months after that first survey, if the responses in the survey resulted in a lower, if the economists concluded that the group surveyed had less confidence than that baseline, then the index at that time was less than 100 by whatever quantitative measures they used. But if people were feeling really confident and things were going really well, then the survey ended up led to an index score of greater than 100. And so as you can imagine, back in January, February of last year, consumer confidence was pretty good. The economy's humming along pretty well. People are going out, having fun, doing stuff. And then all of a sudden, COVID hits. And people are stuck inside. We're trying to figure out how to keep our organizations across the country, across the world open. People are losing small businesses. It's a really, really challenging time for a lot of people in the retail and the hospitality, the travel business, accommodations. Any of those industries that you can think of that would be hit, obviously, were really having a hard time. And so as a result, consumer confidence went way down because a lot of people across the country who were taking part in this survey were not as confident as they were before. So the value of the index, I don't have the number of where it was in like February and then maybe again in like April, May, June of last year. But we've had just recently a really large spike in consumer confidence in general. In February, the survey was distributed and the score was, I had the number on my other screen, 90.4. So substantially, I don't think you can really conclude that it's 10% less than that initial index when it was given in 1985. It might be a logarithmic thing, to be honest. I don't know, but it was at a pretty low point. Last month in March, it jumped all the way up to 109.7. So this all coincides with vaccines being rolled out across the world, more people being able to go out and do things, go to shopping malls, go see movies, travel a little bit more, access hotels, and spend more money. And as soon as more people can get out and do some of those things, we can probably expect spending to go up by quite a bit because people have been holed up in their houses for the last year. And everybody, myself included, is really just itching to travel. Excuse me for one moment. So we have a huge spike in the consumer confidence index as a result of all this. And we're kind of at an interesting point in the markets, and an inflection point in my mind. And I wanted to address this on the podcast this week because we have a couple of different outcomes, I think, and those outcomes are starkly different. I think we have a high probability of only a couple of things happening, and those are two very, very different outcomes. And so the reason that I am interested in all this, I mean, obviously I'm in the business and I'm do this as my day job and I want to help my clients as best I can. But the stuff that I kind of observe in day-to-day life that I could categorize as animal spirits and risk-taking activity are all like happening simultaneously. Here are some examples. Number one, we've had a surge in mergers and acquisitions activity at the corporate level. And so when corporate executives are really feeling pretty good about where the economy's at and what the prospects are going forward, they're putting the pedal to the floor of in terms of earnings growth, which means that a lot of corporations are out there trying to acquire others and merge to create scale. And generally, when executives and decision makers are feeling really good about how things are going, you see mergers and acquisitions activity really tick up. And there's been a huge surge in M&A activity over the last 6 months or so. A large part of that, interestingly, and about 25% of all the M&A, no, I take it back, 25% of all the IPO activity, not the M&A activity, are from what are called these special purpose acquisition companies that you may have read about in the news. SPACs, SPACs is the acronym. And the idea with why these, well, the reason why these are so popular right now is because of the structure of a special purpose acquisition company. If you form this company and think of it kind of like as a shell corporation almost, and I'm not being pejorative at all when I say that, it just kind of is what it is. It's not being used nefariously or anything. But the idea is when you have one of these things, you can purchase private companies and take them public through your special purpose acquisition company. So if I wanted to take my financial planning firm, Three Oaks Wealth, public, which would be a really, really silly idea because we're so small. But if we ever wanted to do that, we could reach out to an investment bank who would buy a bunch of equity shares from us, which would then be distributed into the public market system. But to do that, you have to go through all these compliance headaches, and it's at huge cost. And then on an ongoing basis, the executive team just has a massive responsibility to report everything that's going on, and the amount of disclosures just goes up really dramatically when you IPO in that manner. And that route makes a lot of sense for a lot of companies. But for other companies who don't want to deal with that headache, it makes more sense to become affiliated with one of these SPACs. Because when you go that route, you can access the public markets and grow just the same as you would by IPOing on your own. But when you partner in that manner, you don't have nearly as many of the compliance headaches, which are frankly a massive nuisance to an executive who's trying to make certain numbers. So this is a really popular thing. And what's I think the most interesting about it to me is that there are all these special purpose acquisition companies popping up around the country. And the genesis of them are really wealthy investors who are looking for innovative ways to drive returns, really experienced investment bankers. So the top investment bankers around the country realize that this is an opportunity and are jumping on board and kind of flocking to this structure of how to take companies public. But then when you have an experienced banker and some money behind it from a wealthy investor, they're generating a lot of interest in their company and the IPO by partnering up with celebrities. And so, for example, I think Jay-Z and Beyonce are affiliated with one of these things. Shaquille O'Neal is affiliated with one of these things. Alex Rodriguez is another one. It's kind of crazy that it's happening in this manner, but just kick my trash can. They're marketing their special purpose acquisition companies, and the private companies that they're purchasing, taking public through this vehicle by getting celebrities on board, as if the fundamentals of the stock will be impacted by that. So it's a pretty good example of animal spirits, in my opinion, when you have that kind of frenzied activity where you're just trying to find investor dollars, and there's so much easy money out there that you're getting celebrities on board to just capture people's attention. It's a very interesting strategy. On top of that, you have more traditional IPOs that are still surging, or the number and magnitude of IPOs in the last like 6 months has really taken off. You have Coinbase just went public. That's a really interesting one, and that's mostly because Bitcoin is taking off and growing in popularity, and that makes that platform and business model more viable. They want to continue growing, so they access the public markets by IPOing. But a lot of others, and to be honest, I don't know what the financials of Coinbase look like, but for a lot of others, they're money-losing enterprises and corporations. And just like in the dot-com bubble 20 years ago, where tech companies were going public without having any earnings, you have a fairly, I don't know if I'd call it substantial, but a reasonable number of these IPOs coming out today are in the same boat. They're going public with maybe a little bit of cash flow, but no earnings yet. And that's another example of animal spirits. I'll give you a couple more that are in the news. Non-fungible tokens. If you've heard of these, this one blows my mind. NFTs, where you have a piece of digital artwork. And the definition of that is you can be pretty liberal with it. But non-fungible meaning that it's unique. It's the only one out there. You could have copies of it, but you buy the original piece of digital artwork. And these things are bought and sold on message boards and exchanges online. There was one that I read, and I couldn't even tell you what the NFT actually was, but one of them recently sold for $69 million. Jack Dorsey, who is the founder of both Twitter and Square, his first tweet recently sold as an NFT for $1 million. This is just a string of code. People are paying for original pieces of digital artwork. It just blows my mind that there is such demand for that kind of stuff. Of course, you have crypto assets that are going haywire right now. Bitcoin is, until maybe a couple weeks ago, it shot straight up. It was over $60,000 a coin. And then you had, I think it was like a tweet from someone saying that the Treasury Department was about to crack down on money laundering through digital currencies. And it was a rumor. It was never confirmed or denied, at least to my knowledge. But just the fact that rumor started circulating on the internet caused a 14% drop in the price of Bitcoin, and more than 14% in some of its other cryptocurrencies like Ethereum, Dogecoin. I think that's how you pronounce it. Couldn't tell you, to be honest. So crypto assets are going bananas. More recently than that, President Biden announced that they're considering raising long-term capital gains rates, which I'm sure we'll cover in a future podcast. But that's caused Bitcoin to retreat a little farther. But that's another really good example of animal spirits. So there are all these things going on in the world, just everyday observations that kind of set off a trigger and a bell in my head saying, holy smokes, that's a really speculative thing that people are doing out there, spending millions of dollars on these NFTs, getting celebrities involved in their SPACs, and the level of M&A activity. We have a ton of easy money out there because interest rates are so low, and we have so much government spending and all of that. But it's a prime example of a period where people's confidence is really high, even though the economy isn't quite back up to speed yet. We're getting there, but we're not quite back to where we were a couple of years ago. And just by virtue of people starting to get vaccinated, starting to venture out into the world, just consumer confidence is through the roof. So I know I've kind of rambled on here for a little bit, but my whole point in covering this today was that we're at an inflection point, in my opinion, of where we're at in the markets. Because when you combine all that consumer confidence and all those animal spirits with what's actually happening in the stock and bond markets, right now, equities continue taking off and going up and up and up and up. And we're off of a first quarter of the year where equities across the board had a really strong 3-month period. If we compare equities to the earnings that group actually produces, and there are some limitations of just relying on valuations. I'm not just relying on valuations here. But if you compare the cost of this group of stocks to the earnings that they actually produce, they're really terribly expensive. And that tells me that the market is really priced in an expectation that the economy is going to keep growing and just keep chugging along and get back to where we were in 2018, 2019 in no time, maybe the next 2 to 4 to 6 quarters. And there's a pretty reasonable chance that could happen because vaccinations are being produced by the million every day. I think we're up to almost a third of the U.S. population has been fully vaccinated. I want to say like 45% has gotten one dose. And so as we approach this herd immunity, you think that, well, yeah, the economy is going to keep going and going and going, which means that if you have a stock trading at 100 and it produces $5 in earnings per share, that means that your PE ratio, or price divided by earnings, is 20. Well, right now, PE ratios across the market are like in the mid-30s, which is pushing as high as they've ever been. And that can be okay. That can still lead you to a good outcome if the economy and if earnings continue that upward trajectory to get back to where they were before. Because really simply, if you increase the denominator in any fraction, it reduces the value that you get by dividing the numerator by the denominator. And so that's what markets are kind of expecting. They're saying, I'll pay a high multiple right now because I think that we're on an upward trajectory, and the multiple after we rebound to where we were before is a reasonable level for me. So that's possibility number one. There's a pretty strong chance that that'll happen. And if it's the case, we still haven't seen a whole lot of inflation. I know there's a lot of fears that because of the level of stimulus and the amount of money circulating the banking system, that inflation is going to go out of control. Prices are just going to start rising all of a sudden, which is a very real risk. But it's not here yet, and the Fed seems to be handling it pretty well. So time will tell there. But here's the rub. The other possibility here is that if there's any hiccup in the economic rebound, and let's say earnings, corporate earnings don't increase as much as we are hoping and expecting that they will, we're going to see a correction here in the market at some point. And again, I'm not advocating, as long-time listeners of the show and readers of me, if you know the philosophy and my thought process here, I'm not saying that we need to enter or exit the markets based on economic numbers or anything else, but I'm just to share some observations here. If there are any hiccups at all, we could be in for another really substantial correction, and that can happen almost overnight. And by hiccups, I mean, well, if we have another surge in maybe one of these COVID variants and states across the country have to shut down businesses and keep people in their homes again, that's a very real risk. And that could happen because we don't get vaccines out quick enough. It could happen because people are reluctant to take the vaccine, and we don't reach that herd immunity that is an objective of every state governor out there. Right now we're on the right track, but something like that could happen. A mass cyber attack could happen. Tensions could continue to rise with China or Russia or other countries that are trying to jab at us and get a larger share of global power. Anything like that is possible. And the only reason I'm pointing this out is because Animal spirits are really high. And I think that's part of the reason that's why markets continue grinding higher. We have easy money. Interest rates are very low. We have all these animal spirits out there. We have all, the entire U.S. population has been waiting to get out of their house again and get back out to travel and do the fun stuff that they want to do and see their families and their friends and get back to their lives. And so there's all this pent-up demand and animal spirits in a situation where the economy isn't terribly good. So that's why this is a somewhat unique situation in that usually animal spirits come out when in a way that's directly related with the economic cycle. They were really high back in 2000, and then the tech bubble popped, and they were really low in 2002. In 2006, animal spirits were very high. Everybody was buying houses. You have these liberal mortgage underwriting standards where anybody could get approved without documentation. And then the mortgage crisis happened and consumer confidence in animal spirits fell. Well, the whole world is kind of expecting economic growth to rebound substantially, but we're not there yet. Yet the animal spirits are at a very high level as graded and measured by the Consumer Confidence Index. So it took me a while to get here in this podcast this week. I hope that we still have a reasonable amount of people who are still listening to it. But I bring it up because it's kind of a unique circumstance. Animal spirits and the economy are usually pretty closely linked. This time they're not as closely linked, which just means that we're relying that much more on the economic rebound. Because if you take some risk and then the economy turns on you and doesn't rebound as you expect, there's a lot of people out there that are over-levered, that might wish they hadn't bought that NFT, that could really be in for a hurt if Bitcoin, crashes 50% from here, which is just as likely as it doubling again, in my opinion. So that's it for this week. I hope this was relatively helpful. Just some observations I have about what's going on in the market. As always, don't adjust your long-term strategy or philosophy because of any short-term observations. It's just a very interesting time for practitioners like myself. Okay, that's it for this week. I will talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.